Good afternoon. Happy Friday, August 21st. Wow, what a volatile week in the mortgage rate environment. And a lot of this around what's happening in the bond market. A lot of levers getting pulled this week, which caused mortgage rates to improve and then suddenly reverse course. Bond traders notoriously react quickly. And then as the dust settles, can reposition quickly as well. All told, we're finishing out the week slightly worse than how we started the week. That is not welcome news. That's not what we want to hear. We want to see that things are improving, affordability picture is getting better, but we're just not getting that realized. Let me flip the screen around and we'll walk through it together. Here's mortgage-backed securities. We're down 19 on the day. That's the wrong way, not where we want to be headed. The 10-year Treasury at 4.74. If we scroll down the page and take a look, you can see we started out the week right about here, and we're finishing just slightly lower. That's resulting in upward pressure on interest rates. So much of this volatility happened midweek, and really what went on here is that the Treasury announced that they would be doubling their bond purchases on the long end of the yield curve. These are 10-year, 20-year, and 30-year bonds, and the Treasury announced that they're going to increase their buying of those bonds by 100% from 2 billion per operation to 4 billion per operation. It's not a significant sum of money. It sounds strange to say that 4 billion is not a significant sum of money. It's not a significant sum of money in the world of the bond market, but it does represent a willingness or an attention to the matter from the Treasury that, hey, long-term yields are inching up to areas that are uncomfortable. And these affect things like mortgage rates, for instance, any sort of long-term borrowing cost. This is going to affect and going to make it more expensive. That's obviously not welcome news when we still have inflationary pressures as well. And of course, the war in Iran still going on. So the Treasury makes these moves to buy on the long end of the yield curve. But here's the problem. We're not a country that balances its books, nor do we run a surplus. So really the only way the Treasury has to do this, the Treasury can't print money. That's the domain of the Federal Reserve. What the Treasury can do here is sell on the short end of the yield curve. They can sell short-term notes, short-term debt, and take that money, take that capital, and buy long-term debt. It's a little bit like borrowing from your MasterCard so you can pay off your American Express. And it resulted in some mixed reviews. This is an article from Politico here that talks about the Treasury Secretary Scott Bessent on Wednesday announcing that the federal government's going to buy back more of its own debt, right? A move that was designed to help mortgage rates and consumer borrowing costs. And this individual from State Street Investment Management says, hey, but this is a drop in the bucket relative to other pressures on yields, meaning this is a valiant effort, but it's likely not to halt the upward pressure on yields. There's a little bit more down the page. The buyback plan lifts the previous ceiling from 2 billion per operation to 4 billion per operation effective September 9th. So they haven't even really started yet. It's just the announcement that's baking its way through. The increase reflects the Treasury's desire to provide greater liquidity support in longer dated nominal sectors where there's consistent, strong sponsorship from market participants. So trying not to be too panicky there, but ultimately this goal is to drive down long-term interest rates. When you start talking about the United States debt, let's go back 10 years ago. The United States debt 10 years ago was just a shade under 20 trillion, and the single largest holder of that debt was China. Number two there, Japan. Number three, Ireland. These are who held the United States debt. China held over 1.8 trillion in US debt back 10 years ago. But as we move forward, you can see China starting to divest itself, dropping down to just over 1 trillion 5 years ago, Japan taking the top spot. And then as of 1 year ago, China is all the way down to 699 billion. So China divesting itself, selling off United States treasuries. Japan now over 1.18 trillion. The United Kingdom ramped up its purchases. But fast forward from 1 year ago when our debt was 37.5 trillion to today, we're now over 40 trillion today. Japan still the largest holder of debt, and China has continued to divest US debt down to 633 billion. That extra supply hitting the market doesn't do any favors for us and certainly helps compound the problem we see driving up long-term yields. If we scroll down the page here, and I'll include a link to this if you're getting this in an email, you can see this is our overall debt in the United States. So 19.5 back at 10 years ago, all the way to 40 trillion today. But check this out. Here's federal spending. So federal spending for the year 2016 was 3.85 trillion. In 2021, it was 6.82 trillion. Last year it was 7 trillion in federal spending, and so far to date, this is through today, the federal government has spent 7.3 trillion. Now we still have September, October, November, December to go. We've still got 5 months to go this year, and we are seeing levels. We've already eclipsed all the spending from last year. That's just a significant amount of debt and has really got some upward pressure on long-term yields. And unfortunately, that's playing out in the mortgage-backed securities market. Not to be outdone, pending home sales posted this week. It was not a particularly good July. We're down 2.2% year over year. The purple line here represents pending home sales. The amber line represents existing home sales. As you might imagine, pending home sales lead existing home sales, and this dates all the way back to 2017 through the pandemic. And as we move forward here through today, 2026, I'll narrow this look for you, and we can zoom in here a bit and see pending home sales, this sort of purplish line leading existing home sales. And you can see this drop off here of late. It's anticipated we're going to see existing home sales as of the next report likely start to decline as well, as we've had 2 months in a row now of pretty significant downside for pending home sales. All of this is around where interest rates sit. And until we get interest rates, a par interest rate down at 6.5% or below, it's tough to imagine a meaningful recovery in existing home sales. But the good news is we have tested this theory multiple times over the past 3 or 4 years, and every single time the par rate for a 30-year fix drops below 6.5%, we see a healthy rebound in activity. In other words, there is plenty of demand out there. We just have to get interest rates or affordability back to a threshold that's acceptable for the average American, and we're going to see the housing market recover. Until then, lots of upward pressure on interest rates thanks to the amount of debt that our country carries. If I can be of any service to you over the weekend, don't hesitate to reach out, mark.milam at highlandmtg.com. Have a good weekend.